Is the economy hurtling towards a recession? Get ready as we dive into startling financial trends, market crash predictions, and the latest in the crypto world.
We'll unpack expert opinions on the Federal Reserve's moves, inflation spikes, and potential recession indicators. Don't miss this urgent financial news review. Your investments might depend on it.
We're summarizing today's top videos in the world of stocks, real estate, and the economy. Like and subscribe for the day's must-know updates, delivered in quick, easy-to-understand segments.
And stick around for the end, where we'll break down areas of agreement and debate among our experts.
First up, Adam Taggart and Michael Leo discuss why high Fed rates could crush the economy. Next, Brett Heath warns about inflation's return to 9%. Game of Trades explores whether the 30% S&P 500 rally is a bubble about to burst. Michael Silva assures beginners they can navigate upcoming market moves with ease. Jack Farley explains how deflation could reshape crypto, gold, and tech. Bob Quartermain discusses why soaring gold prices aren't boosting mining margins. Chris Ciovacco assesses charts signaling the end of the bull market. Jay Jacobs predicts AI-driven gains spreading from big tech to the broader market. Welcome back to Thoughtful Money on YouTube. Today's hot topic: Fed fears too high rates are starting to crush the economy, featuring some razor-sharp insights from our resident expert, Michael Leo. Get ready, folks, because we're tackling everything from high interest rates to market reactions and economic shifts.
Absolutely. And let me tell you, Michael brings not only his expertise, but also some wit and wisdom that really helps break down these complex topics. Buckle up.
All right, let's cut to the chase. What's the main takeaway from this video?
Simply put, the Fed is getting increasingly worried that high interest rates are setting the stage for economic trouble. Jerome Powell might want to ease policy soon, but he's stuck between a rock and a hard place, with inflation still a lingering concern.
Let's delve deeper. What's the latest on inflation and interest rates?
The latest CPI data shows a decline to 3.0% from 3.3% year over year, mainly due to falling gas and auto prices. Core CPI fell slower but still indicates a positive trend. Yet Powell is moving cautiously, balancing the risks of high rates and inflation.
Interesting. So what's the Fed grappling with here?
Powell's stuck in a tight spot. He'd love to ease rates, but fears rekindling inflation. Moreover, data inconsistencies and the lagging impact of high rates make his job even trickier. Michael highlights CPI less shelter at 1.8%, suggesting the real inflation rate is more manageable.
Got it. And how is the market reacting?
The market is predictably optimistic, jumping at any hint of rate cuts. This behavior isn't new, but such reliance on a few giant tech stocks like Nvidia creates fragility. There's also a growing concern about the market's breadth.
What could trigger a significant economic shift?
Corporate debt re-rating at these high rates could lead to job cuts and tighter budgets, increasing recession risks. Investors need to stay vigilant, especially as bond markets might react strongly to shifts in unemployment or inflation data.
So, crystal ball time. What are Michael's predictions?
First, they're bracing for a potential recession due to the compounded effects of high interest rates. Second, they foresee major tech stocks facing correctional pressures, which could reshape the broader market.
Wrapping it up then, what's the final word?
Michael and Adam emphasize the need for cautious, informed investments. They advocate for adaptability, given the market's dynamics and the uncertain economic landscape. Stay informed by understanding both the bullish and bearish perspectives.
Welcome to another thrilling episode on David Lin's channel. Today's hot topic: what's driving inflation back to 9%? And is there an 85% chance of a Fed rate cut by September? Joining us, Brett Heath, CEO of Metalla Royalty, is here to spill the tea.
You bet. Brett dives deep into the recent CPI data, gold price movements, and gives us his insights on what's coming next for the market. Stick around, it's going to be a wild ride.
So, what's the core message Brett Heath is trying to get across in his discussion?
Heath argues that despite a slight dip in CPI, inflation is set to roar back to 9%. Oh, and there's an 85% chance of a Fed rate cut by September. He says these trends are signaled by market reactions and gold prices.
Let's get into the detailed key points. First, what's going on with the CPI data and market reactions?
June CPI data showed a slight month-over-month drop of 0.1%, bringing the annual rate down to 3%. Gold prices jumped by 1.7% today, while the S&P 500 fell by about 0.8%. And tech stocks, oh boy, they're leading that downward charge.
Interesting. What about the Fed and potential rate cuts?
Heath thinks we'll see 1 or maybe 2 rate cuts this year, but don't get too comfy. They'll be short-lived. Delay until after September, and small businesses could be toast.
Yikes. And how about the inflation metrics?
Heath predicts inflation will exceed previous highs of 8 to 9%, driven by significant liquidity. He points to trends in the M2 money supply as a telltale sign.
Let's talk gold and silver. What's up in those markets?
Gold is a forward-looking inflation indicator, nearing all-time highs. But curiously, major gold ETFs like GLD have seen huge outflows. It's a head-scratcher, right?
And finally, what's going on with the miners and royalty companies?
Gold miners haven't caught up with gold's rise because capital's being sucked into big tech. But Metalla Royalty is poised for long-term gains, with many assets in development coming online soon.
All right, let's gaze into the crystal ball. What are Heath's predictions?
First, he predicts inflation will return to a whopping 9%. Second, we'll see an initial Fed rate cut, followed by reversals if inflation spikes again. And gold? It could rise to between $2,600 and $3,000 within the next year. Hold on to your hats.
Wrapping it up, what are the big takeaways?
Heath emphasizes that inflation and gold prices are set to rise, driven by ongoing liquidity and market dynamics. Strategic investment in gold and related equities, like Metalla Royalty, could offer solid returns amid these trends. Watch this space.
Welcome to Game of Trades, where we decode the mad world of the stock market. In today's video titled, "This is not going to end well," we're diving into a jaw-dropping 30% gain for the S&P 500 over the last 30 weeks. Is it a rocket launch to new highs or the calm before the storm? Let's dissect it all and find out.
Absolutely. That kind of gain in such a short time, only 6 times in the last 40 years, makes you wonder if we're on a runaway train or headed for derailment.
Okay, what's the main point Game of Trades is making here? Should we buckle up or enjoy the ride?
The big thesis is whether this incredible rally is a precursor to sustained growth or a sign of an impending peak, like those ominous market moments in 1987, 1999, and 1929. It's like trying to predict if you've got winning lottery numbers or a ticking time bomb.
Let's break down those key points. What's driving this rally?
It's pretty wild. The S&P 500 saw a 30% surge in 30 weeks, a rarity that's happened just 6 times in 4 decades. Looks like we've hit a market jackpot, but previous instances show it can be a double-edged sword.
All right, but who's doing the heavy lifting in this rally?
It's like a clique of popular kids. 7 stocks have soared by an average of 140%, while the rest have barely scraped past 20%. Classic case of a few stars carrying the whole show.
Yikes, that rings some historical bells. How does this compare to past market surges?
Exactly. When we look back at rallies from 2020, 2009, 1986, and 1982, broad participation was the secret sauce for continued growth. But thin participation spelled doom in 1987, 1999, and 1929. Think of it as the difference between a well-attended party and one where only the life of the party shows up.
What's the story with today's market behavior?
Surprisingly, the advanced decline line isn't looking too shabby. It hit a new high in May 2024. So while the tech giants are stealing the spotlight, the rest of the market isn't totally flopping on stage just yet.
Time for some crystal ball gazing. What's in the cards?
If the broader market starts to sink while the S&P 500 keeps climbing thanks to a few heavy hitters, we could see a repeat of 1999 or 1987, followed by a downturn. However, today's technicals still show strength, so keep your seatbelts fastened and eyes on the road.
So what's the final takeaway?
Stay cautious but optimistic. The rally's impressive, but history tells us to watch market participation closely. It's all about balancing risk and reward. Keep informed and adjust your strategy as needed. Trade smart and trade safe.
Welcome to Figuring Out Money. Tonight, we're diving deep into the stock and crypto market updates. It's a packed episode, so grab your favorite drink and let's get into it.
That's right. Michael Silva is here to guide us through what's been happening in the market and what to look out for next week. Spoiler, it's going to be a wild ride.
All right, so what's the big takeaway from Michael Silva's discussion?
Even beginners can handle what's next in the market. The key is to understand and track vital indicators like gamma levels, moving averages, and intermarket relationships. Michael breaks it down so anyone can get the hang of it.
Got it. Let's start with the market conditions. What's on the radar?
Next week is busy. We've got Fed Chair Powell speaking, retail sales data, building permits, and initial jobless claims reports. Plus, earnings season kicks off with major players like Goldman Sachs, Bank of America, and Netflix. Buckle up.
Sounds intense. How's the current market trend looking?
Mostly bullish. The S&P 500, NASDAQ 100, and small cap index are all in uptrends. But there are hints of potential pullbacks, especially if key moving averages are broken. Silva suggests keeping a close eye on those signals.
What about intermarket relationships? Any cool insights there?
Definitely. Silver and gold miners usually move together, but recent divergences hint at potential minor weakness if silver consolidates. Plus, if the dollar or the 10-year yield bounces back, it could pressure the stock market.
Interesting stuff. And what's happening in the crypto world?
Bitcoin and Ethereum are in a bit of a holding pattern, consolidating at key levels. Some crypto equities like Marathon Digital and Coinbase are showing potential, but they're high-risk, high-reward plays.
Let's pull out the crystal ball. Any predictions?
For sure. Michael predicts the market will stay bullish if it stays above key moving averages and gamma levels. But if it dips below these, we might see some turbulence. Also, earnings reports could drive significant moves in individual stocks and sectors. And for crypto, we might see breakouts if conditions stabilize.
So what's the final word from Michael Silva?
Stay cautious, but be ready to seize opportunities. Understand the indicators, keep track of trends, and stay flexible. Michael's advice: stay informed, adjust your strategies, and don't be afraid to make those smart moves.
Welcome back to another weekly roundup on Blockworks Macro. Today, we're diving into what deflation means for crypto, gold, and tech. And who better to walk us through it than the insightful Jack Farley? Get ready for a whirlwind of economic insights.
Absolutely. Jack's got some compelling points on how recent deflationary trends could shake up these markets. Let's get into the nuts and bolts of it.
So what's the main takeaway from Jack Farley's analysis? Why should we care about deflation?
The gist is that deflation could substantially impact different asset classes, particularly crypto, gold, and tech. With cooling inflation data, we're looking at a possible paradigm shift in these markets.
All right, break it down for us. What's the scoop on the latest inflation data?
Core inflation year over year came in at 3.3% versus the forecasted 3.4%. And get this, headline inflation month over month hit negative 0.1%, marking the first deflation since 2020.
Wow, that's a first in a while. What sectors are driving this deflation?
Shelter costs took a significant dive, being a major driver. Core services showing a great decrease too. It's been influential in making the Consumer Price Index, or CPI, lower.
So how are markets reacting to all this?
Big time. Markets are expecting rate cuts, possibly as early as September. Plus, small-cap value stocks are seeing strong performance on this data.
All right, prediction time. What does Jack foresee happening next?
Jack predicts a likely rate cut in September, with Fed funds futures showing up to a 95% probability. Also, a declining dollar and lower bond yields might give a boost to gold and maybe crypto.
Wrapping it all up, what should our viewers keep in mind?
Stay vigilant. While the data looks promising for deflation, shelter costs remain a crucial indicator. Be cautious with leverage in these volatile markets, and keep an eye on how different sectors react to these economic shifts.
Welcome to Kitco News. Today, we're diving into the world of glittering gold, straight from the Rick Rule Symposium in sunny Boca Raton, Florida. Joining us is the legendary Bob Quartermain, the director of Dakota Gold. Buckle up, we're about to unearth some golden insights.
Absolutely. Bob is here to talk about the soaring gold prices, potentially hitting record highs, and the not-so-shiny reality of squeezing mining margins. Spoiler alert, it's not all Midas touch in the mining world.
So, what's the main takeaway from Bob Quartermain's talk? Is it raining gold, or are there clouds on the horizon?
The key takeaway is the paradox. Gold prices are climbing, potentially over $2,300 per ounce, but mining margins are being squeezed tighter than your budget after holiday shopping. High inflation and production costs are eating into those glittering profits.
All right, let's break this down. What's the word on investor sentiment over there?
Optimism is buzzing. Investors are thrilled with the high gold prices. They're informed, eager to learn, and asking the tough questions about the future, from drilling results to the wider economic outlook. Knowledge is golden here.
Speaking of gold, how high are the prices climbing?
Gold is shooting for the stars, potentially above $2,300 per ounce. Central banks are on a shopping spree, and the tech industry's appetite for gold is growing, especially with AI and electronics chomping at the bit. It's shiny times.
But it's not all gold bricks and rainbows, right? What's squeezing those mining margins?
Indeed, inflation is the big bad wolf, driving production costs up to $1,300 or $1,400 per ounce for top miners. That's why equity reactions haven't been as sparkling as one might expect. It's like finding out your gold-coated candy has a bitter center.
What about the demand for industrial applications? How's that playing out?
Demand is surging. Silver's hitting new highs in electronics and photovoltaic cells. The green transition is propelling the need for precious metals, which are crucial to many of the technologies driving a greener, more sustainable future.
Sounds promising, but what's the situation for the junior miners out there?
It's rough. Raising capital is tough despite high gold prices. Junior miners are turning to strategic partnerships and consolidations to weather the storm. As Bob says, only the right projects attract the right capital. It's survival of the fittest.
All right, get out that crystal ball. What predictions did Bob have?
First, expect gold prices to continue their ascent, driven by technological demands and central bank acquisitions. Second, the green transition will push for more efficient regulatory frameworks to help the mining industry meet 2050 goals. Third, watch for more mergers and acquisitions as companies strive to cut costs and increase efficiencies.
Wrapping it up, what's Bob's golden nugget of wisdom for us?
Education and regulation are key. Bob calls for a better regulatory framework and continuous public education on the vital role of mining in our daily lives. Responsible mining is essential, and with the right strategies, the industry can navigate these challenging times. Bob's optimism is a treasure in itself.
Welcome to CiovaccoCapital on YouTube. Today's pressing question, are the charts signaling the end of the bull market? Chris Ciovacco dives deep into charts, data, and model scores to give us some insight. Ready to get those financial gears turning?
Absolutely. Chris walks us through a roller coaster of information. From CPI reports to small caps, the breadth of the market, and interest rate-sensitive sectors, it's all covered.
What's the core thesis of this video? Is the bull market really on its last legs?
Chris is tackling whether the current charts and data suggest that the bull market might be ending. He's breaking it down by examining indices, market breadth, and how recent CPI data comes into play.
Let's talk about the CPI report. How did it move the needle?
The CPI report was a pleasant surprise, coming in better than expected. This bolstered the market's confidence in a potential Fed rate cut by the end of the year despite dips in the S&P 500 and NASDAQ.
Interesting. What about market breadth? Any notable changes there?
Absolutely. Market breadth showed significant improvements, with 279 YSE issues hitting new 52-week highs versus only 9 at new lows. It's a sign that the rally is broad-based.
And what's the deal with small caps compared to tech?
Small caps IWM broke above multiple anchored volume-weighted average price lines, showing bullish signs. However, the tech sector, XLK, remains strong. The small caps versus tech ratio hasn't flipped yet, but it's worth watching.
How about those interest rate-sensitive sectors?
They had a stellar performance amid the CPI aftermath. Small caps, home builders, and the equal-weight S&P 500 all showed strength, indicating a broadening rally.
So what are Chris's predictions based on this data?
Chris suggests a possible short-term outperformance for small caps relative to tech, similar to what we saw in November 2020. However, this may be temporary counter-trend moves rather than a definitive shift.
And what about tech?
The tech sector may see some pullbacks, but it will likely remain robust as long as it stays above key support levels. The broader uptrend is still in play.
What's the final word on all this? Should we be freaking out?
Chris urges caution but also flexibility. While risks exist, the charts don't definitively signal the end of the bull market. The key takeaway is to stay adaptable and keep an open mind to all possible outcomes.
Welcome to Public Apps Recap. Today we're diving into a super relevant discussion from the Leading Indicator podcast, hosted by JD Durkin. The spotlight is on Jay Jacobs from BlackRock. Fasten your seatbelts, folks.
Oh, this is exciting. We'll be unpacking how AI and geopolitics are shaping up to impact the market in staggering ways. Stay tuned.
So, what's the main takeaway from Jay Jacobs' insights?
Jay emphasizes that gains seen in big tech stocks due to AI will trickle down to other sectors. And let's not forget the upcoming election will also play a big role in market dynamics.
Awesome. Let's dig into those key points. Starting with market concentration, what's going on there?
Well, the Magnificent Seven stocks have been dominating the S&P 500, but Jay thinks we'll soon see the market looking beyond these names as AI spreads across various sectors.
Got it. Now, let's talk tech, AI specifically. What's in the AI tech stack?
Oh, it's all about semiconductors, GPUs, and high-bandwidth memory chips. Future AI advancements will boost demand for ASICs and CPUs, expanding the tech ecosystem.
Interesting. And what sectors are positioned to benefit?
AI's growth will demand a lot of real estate for data centers and skyrocket electricity demand, impacting utilities and the energy grid more than you'd expect.
Wow, that's quite a ripple effect. Switching gears to geopolitics, what's the impact there?
Elections globally, not just in the U.S., are pivotal. Policies promoting U.S. manufacturing and infrastructure spending are set to drive significant market impacts.
Fascinating. Sounds like economic opportunities are in the spotlight too?
Absolutely. Big investments in manufacturing and infrastructure have a high multiplier effect on the economy, and strong trade partnerships with Mexico and India are crucial for supply chain strategies.
All right, it's crystal ball time. What's Jay predicting?
Jay anticipates AI-related spending could hit $1 trillion by the end of the decade. Plus, watch out for copper shortages impacting AI infrastructure development. Oh, and inflation? It's here to stay.
And what about emerging markets?
India's looking like a major player. With a youthful population and growing middle class, it's on track to become a global economic force.
To wrap things up, what's the big picture here?
Jay underscores the broad economic benefits set to follow AI gains in big tech, with focus areas including semiconductors, real estate, and energy, and significant geopolitical shifts. Keeping an eye on these elements can help navigate the market's future.
Sounds like some solid advice. Thanks for joining us on Public Apps Recap. Until next time, keep investing wisely. We heard some compelling arguments in today's videos. Lance Roberts and Adam Taggart worry that high Fed rates are debilitating the economy. Brett Heath projects a resurgence in inflation, urging caution in the face of an unpredictable market.
Game of Trades warns that the recent S&P 500 surge may be a bubble waiting to burst. Conversely, Michael Silva believes that even beginners can navigate the turbulent waters ahead with informed strategies.
Jack Farley dives into how deflationary trends can revitalize crypto and gold, whereas Bob Quartermain highlights the paradox of high gold prices and squeezed mining margins.
Chris Ciovacco remains cautious but open-minded, suggesting that the bull market might have some runway left. Lastly, Jay Jacobs sees AI gains extending beyond big tech, benefiting diverse sectors over time.
Our experts agree on the pressing risks of high Fed rates and inflation, but diverge on market trajectories and investment opportunities. Stay informed, stay prepared. Thanks for watching Financial Analysis in Review for July 13th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.